In the previous video, we talked about this very scenario playing out where you have further downside on the S&P. This was coming off the heels of Trump talking about moving more troops to the Middle East. He's then backpedaling, trying to pump the market up, saying the conflict will be resolved soon. Maybe the US will just leave the Strait of Hormuz and Iran behind and let others deal with it. But really what we're seeing in the market is just this rounded top that we've talked about before, this sell signal that we've had on the indicator, and we are now breaking quite decisively down from even these sort of support levels that were really your last hope for a potential buying up of the S&P. So I am fully expecting a continued rollover here. Probably the midpoint of the parallel channel will be your next point of support on this particular chart, down another 3% or so. Maybe you can recover a bit and chop around in these sort of levels before heading even lower. That would be my most likely base case at this point in time. Last week, we talked about how whenever you get a sell signal on the S&P like this, you do end up heading to the bottom of the parallel channel. It's a very powerful signal, and I think this is no different. I think we will be heading down to the bottom of the parallel channel. I'm positioning accordingly. I do think there's going to be some nasty downside coming. Now, that doesn't necessarily mean that this is the absolute end of the bull market. In general, of course, back with the tariff scare, you wicked down essentially to the bottom of the channel, and then you were able to make a V-shaped recovery and come all the way back up to the top. We will have to see how the macroeconomic factors are looking once we are down at the bottom of the parallel channel. It's possible that we could reverse from there. I'm going to leave judgment on that till we get to that point in time. But part of the problem has been that oil is continuing to trade a very high. As US oil around $98, Brent is higher. And of course, if oil prices stay elevated, then that is going to eventually bleed into the economy as a whole. Businesses are going to experience higher costs. Individuals are going to need to spend more money on gasoline. That's just going to be really bad for the economy overall. So that being said, I do, to be honest, think the economy can handle higher oil prices. To be honest, when you factor in inflation and the fact that the economy is much more service and software based than it used to be, I think these kind of oil prices are not necessarily a nail in the coffin just yet. You probably need to see higher oil prices before I would start getting really concerned that demand is going to roll over and you're going to have a recession. The recession odds are something like 35% for this year at the moment, currently on Polymarket. So I don't think it's a guarantee that you're going to get a recession imminently. I think it's more likely we're going to hang around here on oil, maybe trend up a little bit over time if there is no resolution in Iran to the conflict. And in fact, there may be escalation coming with the moving of US troops to the region. I think they'll do some kind of boots on the ground type adventure there to try to secure the Strait of Hormuz and potentially gain leverage against Iran in terms of taking their oil production facilities offline, something like this, maybe seizing their oil tankers as well. So with that in mind, I do think oil will continue to trend up. I don't think it's going to result in recession right away, but I do think you're most likely going to have an uptick in inflation. It's very much what the 10-year and the 2-year have been saying. We are increasing on the 10-year and increasing on the 2-year. This is a bear flattening, essentially, of the 10-year minus the 2-year, as we see here. We spoke about this in previous macro reports, and we said, you're most likely going to flip over here and come down into the negative. And this is essentially the bond market pricing in much higher inflation going forward, and perhaps indicating that the Fed will even need to raise rates. And in fact, after the FOMC meeting, you did have the committee much more open to rate raises in the future as opposed to rate cuts. So we have to keep this sort of inflationary impulse from oil in mind. It's exactly what we predicted in several of the macro reports going back a couple of months ago. And we said that this would likely be first domino to fall, and that once you get these high oil prices, it tends to lead to a recession or even just a bear market in the stock market as you had in 2022 and 2008. So this being the case, I do have some very interesting information that might counteract this thesis. So one thing to note is the ISM has actually been going higher, and typically when the ISM breaks these kind of levels after consolidating, then you do go higher. Now what the ISM is essentially the manufacturing orders that are coming in, like how much demand there is for the real economy spending. This is industrial stuff like, chemicals and oil and machinery and all of this kind of stuff. So with this going higher, to me, this looks like there might be actually a reignition of the real economy, which has been essentially in a bear market for quite some time with these sort of very low readings on the ISM. You've been in a bit of a stagnant period for the real economy. We've seen that through all sorts of charts. For example, a company like Pepsi, you've had essentially quite terrible performance, albeit you're in an uptrend, but since 2022, you've really been in a sort of bear market and only now just recovering out of that. I think, to be honest, it looks to me like moves in Pepsi and particular chemical stock, a bunch of chemical stocks have put in quite similar price action where you are getting a bit of a recovery. I think this, to me, the stock OLN, for example, a chemical stock, sort of some of these more boring sort of industrial, real economy plays have just been really languishing for a long time. Huntsman, you see here, been in a bit of a bear market since 2022 still. So I have a thesis here, which is essentially that, and you see now they're putting in buy signals, which may or may not come to fruition, but my thesis is that there are a bunch of stocks, this one as well, another one that's just been in a bear market essentially since 2022, when the real economy began to suffer due to the Fed raising rates. And since the Fed have not really lowered rates to a more dovish stance where, the rates are essentially below the neutral rate and causing increased inflation and making the economy reignite, we've not seen that. So these kind of stocks have been in a long period, a long bear market essentially, while tech stocks and all the rest of it have been running up massively. So I think that the economy and the GDP avoided essentially a recession because you had stocks like Google, for example, and all the AI stocks, Nvidia, etc., had some massive bull runs, went on a massive bull run essentially since 2022, 2023. And I think this saved the economy from a more prolonged sort of recession and bear market. I think all of the AI spending and infrastructure spending has essentially masked the weakness that was experienced by the economy over the past few years. And I actually think, this being the case, it's actually possible we might be nearing a bottom for the real economy, and actually you could get a turnaround from there. Now, the one wrench in that plan is the oil price, and as we've said already, this being elevated for longer does pose an existential threat potentially. If there is already market weakness, labor market weakness, that could be a problem. But to me, it's actually looking like the Fed did manage to thread the needle and essentially engineer a bit of a soft landing. And if they were able to then cut rates and reignite the economy, you might actually have avoided a nasty bear market in the stock market and sort of extend the AI bubble and the spending and the debt and all the rest of it that is powering the AI trade. So when I put all of these components together, to me, it looks like the Fed will probably be forced to hold rates steady, but there might in fact be an uptick in the economy in general as this cyclical ISM process plays out and you actually get an uptick on this metric and you have sort of a reignition in the economy that takes people by surprise. Now, of course, there were all these sort of tax cuts and infrastructure spending that's been passed by the Trump administration, which has maybe gone a little bit under the radar. And this kind of stuff could actually ignite the real economy and prop up the markets. I do expect the S&P is still going to go down to the bottom of this massive parallel channel, as we've talked about already. But I'm not necessarily sure that that's actually going to be the end of the bull market. It might just be a sort of correction and then back off to the races. That sort of wouldn't surprise me too much, particularly if this drop in the S&P leads to further labor market weakness and the Fed decides to cut rates to support the labor market and the economy in general. If the weakening in GDP, the weakening in, the increase of unemployment scares the Fed and they actually do cut rates further, then I think you could reignite and go even a lot higher, potentially getting even maybe a blow off top a couple of years down the line, perhaps. So that's my thinking here. You might just have higher inflation while oil is sort of remaining higher for some period of time. And the Fed might just accept that higher baseline inflation, decide to cut rates anyway to stimulate and sort of let the economic cycle play out fully. They, of course, need to refinance the debt as well, which is a lot easier if you have lower rates. So I think the market's actually being quite tricky here, and it's a very nuanced take that we have to have. I do expect, we're probably going to head down to the bottom of the parallel channel, but it's possible that actually we are going a lot higher from there and that we won't break down and have sort of a miserable recession, Great Depression style crash and all the rest of it. And, now, of course, that could happen and very much we could have like an extended nasty bear market and break these sort of levels and go a lot lower on the S&P if the Fed is forced to raise rates or, makes a policy mistake due to the war in Iran. If that's increasing inflation and the Fed sees that and therefore raises rates into a weakening economy or a weakening labor market, then that could cause more unemployment and a recession and sort of a doom loop as the AI takes away jobs, and then AI companies also are going bankrupt, and it could just be really quite a disaster in that regard. So I'm expecting that they hold rates steady and it's going to be a bit of chop and a bit of misery in the markets. Perhaps we go down to this sort of level, and then at this point maybe the Fed decides to step in and say, actually, you know what, we need to lower the rates to save the stock market and the economy, and then you're back up. Because I think on some level, the stock market is also a very important factor. If it goes down too much, that can be a self-fulfilling prophecy for creating a recession, as people have less money. Consumers are therefore less willing to spend, and you could enter a doom loop and go a lot lower. Forgive my drawing on this particular chart. So I think if the stock market shows a lot of weakness, which it will do, I think in the coming months, the Fed might decide to actually step in with the lowered rates, maybe even quantitative easing, just accept the higher inflation, and then you have a sort of stagflationary period with high inflation and lower rates. But I think then that reignites the real economy, and you have some, some big moves in the plays that have otherwise been in sort of a bear market for a very long time. Now, this does mean that tech is probably going to suffer no matter what, because you're going to have this massive sell down on the QQQs. Yes, you might get a bounce, and in fact, if they do decrease the rates, then I would expect the QQQs to again do very well, and for tech to outperform. So essentially, that's my idea here. I think oil continues to outperform in the medium term, in the short to medium term. I think then eventually the Fed is going to be forced to react to the downside in the stock market, and at that point, there may be, in fact, a strong recovery rally as you get the cyclical manufacturing increases coinciding with rate cuts, coinciding maybe even with some kind of resolution with the war in Iran. That could all be sort of a perfect storm for, maximum fear. The war with Iran, it's all just terrible. They're going to have to raise rates, higher inflation, blah, blah, blah. It's all terrible. And then maybe the Fed says, you know what, we're going to cut the rates. The economy is looking too weak. And we say, whatever, it's fine, inflation, we allow it. Meanwhile, the Iran situation resolves, and suddenly you're going a lot higher and catching people offside again as they sell the bottom on peak panic and fear. So that's the overall macro outlook. A bit of a talky episode today. If we look at the stocks now, interestingly, gold has been going down quite a bit. This is, I think, mostly on the fears of the rate hikes. If the Fed is rate cutting, then that's going to be good for gold. But if they're rate hiking, then it's obviously going to be bad for gold and risk assets, and you're going to prefer to be in cash. Cash will become king. I still don't think they're going to raise rates. I think that's less likely than them actually cutting rates, especially people do think Kevin Warsh is a bit of a hawk, but I think he will be wanting to do as he said to Trump and lower rates. And I think also it will be hard to avoid the labor market weakness and just general signs of deterioration. And the AI trade, I think it will need to be propped up by lower rates. The debt for the US Treasury debt as well also needs to be refinanced. So there's just a lot of factors that to me think this is a sell-off, but I think you are going higher on gold at some point. You've seen crypto's been holding up pretty damn well, actually, despite this sell-off. So I wouldn't be surprised if we do get one final flush, as I've talked about before, to the downside once the S&P goes down to the bottom of its parallel channel as well. That would not surprise. But I think on some level, there's not going to be too much more downside to come for Bitcoin. One final shakeout, and then we can build a base and go from there on crypto. As a result, it's a similar story on BMNR and MSTR. Not too much to talk about from the previous videos. We're still trading in this sort of bear flag on BMNR. On MicroStrategy, we spoke in my last video about how it's possible, actually, this could be the proper low, or if you are going to find a new low, it might not be much lower than this one. Perhaps we go and we test sort of the $100 mark, something like this, and then find a double bottom. That would not surprise me. Hood is showing more weakness, but again, it's going to just suffer on this final flush on cryptocurrency potentially, right? We had that sell signal, and of course, just a little bit of a brutal bearish price action after that point on Hood. Circle's still been a strong performer. I kind of imagine that this could see some weakness if we do get a final flush, as I've talked about on crypto, and maybe that's when you do a bit of a retest of the parallel channel here, and then go higher from there on Circle. ASTS and Rocket Lab both being a bit hammered on Friday with all of the blood in the market. Now, I didn't speak about how it's possible that you could, in theory, get a bounce on the S&P, and in fact, you did get a bit of a buying up of the markets after Trump suggested that the war in Iran might wind down. So perhaps we'll get a bit of a recovery rally. We did talk about how this could be a cup and handle pattern, and you get a bit of a pullback here, maybe some false, positive movement, and then we actually break down further. That would not surprise me too much. So we might see some positive price action, next week for, a couple of days, bit of a relief rally. I wouldn't be too surprised. VIX, again, is very elevated at the current levels at 26, 27 right now. So this Palantir seems to be breaking down. I don't like the look of it. And this is why I'm just bearish on tech in general, because it's had such a massive bull run, really. And at some point, you do expect this to turn bearish and for other sectors to outperform, really. Rocket Lab's almost at its parallel channel here, which we said would likely happen. I don't know if you're going to be able to hold that level or if you're instead going to break down. It's a bit worrying that you're having this consolidation. To me, that could be some kind of a bear flag on Rocket Lab. You come down here and you have some kind of a bear flag. Forgive me for the imprecision, but something like this, and then maybe you're breaking down from this at some point, maybe even quite soon. So not the best look on the space stocks. ASTS, maybe a similar sort of bearish flag playing out. And I suppose we can say the same thing for iron as well. You've got this negative price action, consolidation, and then what next? Probably further negative price action. We did talk about these levels quite a while ago now, but I did expect you would come back down to $24 or so at some point. And again, I do think we're beginning to see tech roll over a little bit, and this AI trade could get a bit messy and require bailing out by the Fed, lowering rates, maybe providing emergency liquidity and all this kind of stuff. Oracle, the bearish trend continues. I'm not sure how this necessarily will play out. Of course, this parallel channel did provide support in the past, but we bounced from there, but did not manage to go much higher. So it could be that you're actually going to break through this particular parallel channel. With CoreWeave, the price action's been okay. I thought you might go back up and fill this gap and maybe even tag the top of the trend line before heading lower. So we have to see how that one's going to play out. Nebius, very impressive. We've talked about this one. A little bit of consolidation now, and you did leave a gap behind, but the price action's been pretty impressive. I would just hope that you can break these previous highs. Otherwise, you could be looking at sort of a double top type distribution going on with Nebius. SoFi continuing to struggle a little bit. The bearish trend, I think, is going to accelerate. It looks to me quite worrying. I'm not sure I would necessarily be too excited to be owning SoFi stock right now. And again, Reddit also continuing the bearish trend. No real recovery rallies to speak of, and again, looking a bit like a bear flag that could potentially play out further to the downside. We've got NEO, big flush on the Friday price action. I'm excited to see whether this can turn bullish and you can get some really nice price movement here. I'm not sure if I'm going to be a buyer personally, but there is certainly the potential for upside here, all the way to $8.9 or so on NEO. HIMS, the bearish trend continues, and as I sort of predicted was likely to happen, it looks to me like you may have more downside here before the trend is able to reverse and you're able to have some proper consolidation. It's a very similar story with Netflix, where we did manage to get up, big pump, but you're still in a bearish trend. So until you have some kind of a bottoming process, and usually that takes many months, from a sell signal to a buy signal is usually quite a long time. So we'll have to see, but definitely if the markets are struggling, Netflix will continue to go down, I think. Meta finally showing a bit more bearish price action. This looks to me like a massive head and shoulders pattern that might play out to the downside, of course. We've got an initial target at $400, but arguably this sort of distribution pattern is already playing out to the downside. If we take, for example, the left shoulder here, the head here, and a right shoulder here, then arguably maybe we have already broken down from this sort of pattern. And in that case, you could be looking at Meta dropping a further 40% or so, and that would get us to this sort of $400 target. Remains to be seen whether you'll actually go lower than that. But yeah, certainly not a great look on Meta here. Not much going on with Google, seems to be consolidating. Again, you could argue this is sort of a bear flag playing out. You've had negative price action and now a consolidation that's usually favoring downwards price action. But of course, we've already said that it's most likely the SPY and the QQQs are going to go down to the bottom of the parallel channel. So if you have negative price action on the indices, then it's likely to correspond to negative price action as well on the individual tech stocks that are holding up those indices. Similar story with Nvidia. I'm expecting it to come down to the bottom of the parallel channel probably, although you're holding these kind of key levels at the moment. AMD as well. Again, it's just a lot of bearish price action, then consolidation, which to me suggests that downside is coming. Perhaps people are still just hedged a little bit too much, so the market's unwilling to fully break down and have a massive puke day where you lose 3, 4, 5%, or maybe it's just waiting for a catalyst for that. But certainly things to consider. Amazon as well, looking grisly, probably going down to the bottom of the parallel channel still. So overall, looking quite brutal for markets. I wouldn't be surprised if you have a little bit of a recovery rally on Monday, and maybe even subsequent days, just to make this sort of cup and handle pattern look quite convincing. And I think then at that point, you're probably going to experience a big rollover. And maybe we get the Fed stepping in, whether it's, in July. It might come, once Kevin Warsh is actually in the Fed proper as the chair of the Fed. Maybe at that point, he's the guy that says, you know what? I don't want to repeat the mistakes of the past where I raised rates into a weak economy and labor market and whatnot in 2008. He wanted to do that. So I think his psychology might play a part here and get him to raise rates, thus getting a bounce again from this parallel channel on the S&P. Of course, possible we have just a breakdown, possible the Fed even raises rates, possible we get a really nasty depression, recession, all of the AI trade unwinds massively. That might come. I personally expect that to come a few years down the line still, because it will just catch everyone off guard. And typically these kind of mega investment cycles have some kind of a euphoric blow off top as well in the end, once the sort of credit is flowing everywhere, once the rates get a bit lower. And the business cycle picks up in conjunction with that, then yeah, I could see all of that culminating in perhaps a massive crash in a couple of years' time, maybe towards the end of the 2020s, 2029, 2030. And then that would give you the historic parallel to the Great Depression 100 years ago. If you believe in the 100-year cycle, that could be quite a compelling argument. But that's a lot of information. I hope it's not too much to take in. That's my macro outlook for you today. Thank you very much for watching. Subscribe as always for more videos, and I'll see you next time. Bye-bye.